Okay, so let's get started on our webinar for April 10th, How to Survive a Correction. I'm John Schwinghammer, the Alpha Purple Chips. And before we start, of course, we always have to show you this disclaimer. And so now that you've read that, we're going to move on. So first of all, in February, we mentioned in our February 13th webinar, we said it might be years before the Dow breaks 26,500 again. I don't know if it'll be years, but certainly all the signs were there that we were due for some sort of a correction. We also said that at the time, there were only 12 stocks at low valuations, and previous corrections have typically ended with, or let's say that we've been at the bottom of a correction phase when we have more than 25 low valuations. Now, I was looking back at our records, and on April the 2nd, we actually had 25 purple chip stocks that were at low valuations showing on the Purple Chips website. And today, I believe we're at 20 or 22 stocks that are at low valuations. So it means we're in the midst of this correction, and that I think at this point, what we have to be aware of is that there are, we have to be conscious that in a correction, it doesn't mean that you stop buying. It means that you expect things to be a little more challenging. You expect that stocks will not go up to great heights, and there's probably a little more trading. So let's talk about investor sentiment. Okay, I think that investor sentiment has changed because we have President Trump, which is certainly very uncertain. Everything that he does is unpredictable. You know, his staff tells him to do one thing, and of course he does whatever he wants. This isn't good for the market, and it creates a lot of uncertainty. And uncertainty, as I've said many, many times, is the thing that investors hate the most, and that's a good reason for a correction. The other major thing in the background is that interest rates are scheduled to rise, and I still maintain that it is possible that the surprise in interest rates might be on the upside. In other words, interest rates may go higher than we expect. We're accustomed to seeing low interest rates. And for those of you that were around in the 80s as investors, you know very well that Canadian rates did go up very high at that time when gold was rising. And it was a crazy inflationary period that where we saw interest rates do a sudden spike. Now, I'm not saying that we'll do anything like that. That would be scaremongering. But what I am saying is that if you go from 2% interest rates up to 4%, that makes a very big difference. So rates are rising, so be aware of that. And the last thing is that we've got trade wars happening. Mr. Trump is putting barriers everywhere, and with the idea of protecting the American economy, which I think is going to have the opposite effect, which is not good for business. So there we have those comments. Now, how do we behave in a correction? What are the things that we can do so that we come through this correction nice and clean and actually coming out ahead? The number one rule, cash is king. So you've got to have cash available at all times. You have to avoid securities or companies that have a lot of debt, okay? And so what I'm thinking of there is things like REITs, real estate investment trusts, okay? They have big mortgages because they own properties. If rates go up, then the REITs will be under pressure. They're not going to make as much money if rates go up. Same thing with utilities, same thing with telecoms, etc. So anything that has a lot of debt, you want to avoid. Dividends are good because you want to receive that cash, which is going to help you build up your cash reserve. You want to avoid stocks that have high price earnings multiples. Okay, stocks that are trading at 30, 40, 50 times earnings, unless they have growth that can continue. Okay, and the only stock that I'm thinking of that I think is an exception would be Facebook. Facebook is under pressure right now, but they've got the growth rates, and I think they will continue to have them. But avoid, in general, stay away from stocks with the higher PEs. You know, the preference should be on stocks that have lower PE multiples. Point number 5, lower your expectations. So in the past, in a bull market scenario, typically things can get more expensive than expected and keep getting more expensive. In the scenario of a correction, what typically happens is that you have this zigging and zagging where the lows get lower and the highs get lower too. So lower your expectations. And this brings us to the 6th point, trade some and hold some. Okay, so some stocks that you own, you should consider trading out of, banking those profits on strength, and then possibly buy them back again on weakness. So trading some and holding some. Okay, this isn't to say that great companies that you enter at a good price, you shouldn't sell those until you get a decent price. But you've got to have a mix of passive investments and active investments. Now, the next thing, let's see, sell call options. That's a great way to protect yourself in a sideways to lower market. When you're holding great companies, you know those will eventually recover. But what you can do to generate extra income is keep selling call options that are at your price target or at the high end of the valuation range. If you can do that, then you're bringing in income steadily, which is very good. So this is going to be a short webinar, okay, and I want to have a little bit of discussion going. So what I'm going to do is I'm going to open the microphones after, and we're going to talk about some of these things. Now, before I actually move to the next slide, I'd like to ask if anyone has any questions. So I'm going to unmute and see if, let's see, here we go. Okay, so everybody can speak if they want. If you've got your audio set up. So if you have any questions for me, this is a good time to ask, because I'd like to go through this part way and then continue. Anyone have any questions at this point? Leon, I know you're thinking of a few questions. So if anyone has any questions, now's a good time to ask. Or if you want to use the chat box, you can go ahead with the chat box and write something down there, and I'll get to it. Okay, so I'm gonna continue with the presentation here. And as I said, this isn't going to be a very long presentation, but I'm trying to get a point across about the things that you can do during a correction period. And feel free to just jump in if you've got questions about anything. Okay, now, the next thing, do not be too bearish. This is really, really important, okay? If you're too bearish, you're going to miss out on some fantastic opportunities. Great companies go on sale, even in correction periods, and they become bargains. And I guess the one I would point out, we bought Henry Schein back in, let's see now. We bought it not long ago, and if you look at Henry Schein today, I'm going to pull up a little chart here, and I'm going to show you this, just to show you what has happened with Henry Schein. There you go. So this is a daily chart, and there's all kinds of lines on here. The white line is the earnings line, and there's moving averages. And we actually bought Henry Schein when Henry Schein was around the 65 level. And look at Henry Schein today at $70. So I think we made a very good move buying that stock. And at $65, this is the monthly chart, by the way, at $65 where we bought it right here, that was pretty good. And I think the odds favor that this stock, at least it will be worth $80, if not $90 again. Whether it's in 6 months, 3 months, or a year, or 18 months, I don't know. But the outlook is pretty good. This is a terrific company with a beautiful earnings chart. And that's the sort of thing that we want to invest in. So as I said, even though you have a correction phase, and I still think we're in the middle of this correction, it doesn't mean you shouldn't pick up good stocks. So there's things that come on sale that are bargains. And you can also look at those top 20 and the top Canadian stocks as things, when you see something on sale there, like for example, Euronet is on sale. And these are things that are excellent, excellent companies. Euronet is a company that is in the payments business, and it came off recently because Amazon came off, because Trump was talking about Amazon. And, all the companies like Shopify and Square, those also came down. And I think there were some great opportunities in those. And I in fact, did buy positions in Square and in Shopify. And I think these things are excellent long-term investments. They may suffer a little bit if the stock market continues to correct, but I think that the upside potential is still very good. So don't be too bearish. There are plenty of good companies that'll do well even in a sideways to lower market. That's very important to remember. Now, this is kind of fun. This is a chart I want to show you, and this I think is something, we're going to do another webinar just on this subject, okay, on the top stocks in the purple chips. We recently put this together, and we found that the top 20 US purple chip stocks outperformed the Dow Jones equal weight index. And you can see the numbers there, and it's kind of fun. But the thing that I want to point out, the thing that's most important in my opinion, is that when there were declines, okay, because we're talking about corrections, when there were declines, the top 20 stocks went down less than the Dow Jones and recovered much faster than the Dow Jones too. So for example, back in 2008, I don't know if you can see my cursor here, but the Dow Jones went down from 100% in 2007 down to the bottom of the market, down 42%. And then the purple chips, by consequence, went from 100%, they actually only went down 17%. And then they took 1 year, the purple chips took 1 year to recover, and they were actually at a premium. They actually went to 105% after 1 year, whereas the Dow Jones took, in fact, 5 years to recover. So sometime in 2013, the Dow Jones, if you owned the Dow Jones index, you only became whole back to over 100% then. And the fun thing about this top 20 index is that you can see that at any time when there was a correction in the market, like actually what we're facing now, I can see that the top 20 has only corrected maybe 1.5%, whereas the Dow Jones is down about, it's probably more than 2%. Actually, it'd be about 4% from the high. Okay, or actually the end of December 2017. So that's kind of interesting. That's why I think that the top 20 is something that everybody should be looking at, and the top 6 in the case of the Canadian stocks. So the Canadian stocks are even more impressive because in purple chips, we don't look at the resource stocks, and so we've only got great companies. And I'll tell you what those companies are. Those are companies like CGI, companies like Metro, Constellation, National Bank, Alimentation Couche-Tard, and I forget what the 6th company is. But anyway, there are 6 companies that we look at. So the top 6, you can see on this chart, this table, how the top 6 actually gained 200% over the last 5 years, and the TSX 60 equal weighted index only gained 26%. And so that's a tremendous incentive to own something like this. And also, we found that the declines in the years where there were declines in the market, like for example, look at 2015, the TSX went down about 10%, whereas the purple chips, the top 6, actually gained, wow, 40% that year. That's pretty crazy. And this year we're already, we're down on the top 6 just marginally. I would say we're down about 1/3%, whereas the TSX 60, you can see it down about 7, it's down a little bit, not too much. So that's why it's important to not abandon owning stocks altogether, okay? When there's a correction in the market, you want to be careful, but you definitely want to stay in there. Now, I'm going to stay on that slide, And I'm going to answer some questions here now because I see that there's a couple that have come up. Okay, so Leon is asking, what do I think about Amazon and Celgene? Very good question. Okay, now I'm going to pull up the Amazon chart here. Let's see. I'm just going to bring over the charting thing. Now let's look at Amazon, AMZN. So here we've got Amazon. The first thing I'm going to point out, Amazon is a great company. Okay, definitely a game changer. It does not fit purple chips yet. Okay, and I say yet because I suspect that the earnings going forward are going to eventually, maybe after 7 years, we're going to have smooth and predictable earnings. We don't have that yet. So you see the white line, it's all over the place. That tells you that the earnings are quite volatile. Now let's look at the consensus estimates. And you can see here that the earnings are expected to grow in 2018 from 832. They're more or less going to triple in the next 2 years. So that tells you that there's a tremendous amount of growth here. Now, remember I said avoid stocks with very high multiples. Well, the PE multiple on Amazon currently 312 actually. So in my opinion, I like Amazon, but honestly, I may miss this, but I don't think I would want to pay anything more than 1,200 at this point in time, or even 1,100, because I feel like I'm too exposed. And so I don't like, I would not want to own Amazon at 1425, for example. Now, Leon also asked about Celgene, and Celgene, I think, is absolutely the opposite. Celgene has a phenomenal track record, okay? And this, by the way, this could be a top 20 stock. And this is why I want to hold on to this, because we've seen many stocks, and I'll remind you about AutoZone, how there was a chance at one point when AutoZone had this kind of earnings profile, and AutoZone quickly went back to the 700 and some level. We had gotten out earlier, but the point is that these stocks, when things improve, they recover very quickly. And I would not be surprised if Celgene makes its way back to 115 or 120 in the course of the next 12 to 18 months. So that is definitely something to keep an eye on. Good quality stocks are worth holding on to. So we talked about in a correction phase favoring stocks that had dividends and that had low PE multiples, and that had, of course, the earnings profile that we're looking for. In the case of Celgene, we have a low PE multiple. It only trades at 12 times earnings. Now let's look at, it doesn't pay a dividend, so it is a growth stock. But at 12 times earnings, that's discounting a lot of risk, okay? So it's worth holding on to. This stock, somebody could come in, you could get two things that could happen here. One is they could announce some kind of a trial on some drug that they're working on, and they could have positive results, and all of a sudden the stock, even if they're neutral, okay, when a stock is beaten up, even neutral news can be positive news. So the stock could run up because of some kind of positive news. The second thing is someone could acquire them because they're very, very cheap. So let's just look at the consensus numbers for a second. And you can see that the earnings estimates are expected to grow nicely. They're actually expected to grow about, it looks like about 20% a year. As a matter of fact, here's the LTG right here, long-term growth. They expect this company to grow at 19.5% a year. That's quite a bit. And so if you're trading at 11 times earnings and you've got growth of 19 or 20%, that's a good sign. Now let's look at the balance sheet of this company. They do about 13 billion a year in sales. Balance sheet, they've got 65 billion market cap, and they actually have 4 billion of cash, about 3.5 billion of cash, net cash in the bank. You can see the enterprise value, 61.9 billion, and the market cap is 65.4. So that means that they actually hold cash. So again, this is one of the criteria that I look for, okay, companies that have no debt or as little debt as possible for their sector. So this definitely meets the criteria. So Leon, Celgene is a loser right now for us, but I'm holding on to it. I actually hold the options, the long-term options, and a lot of people are holding the stock. So I'm a believer in this. I've got a large position in this, and I think at some point I will be rewarded. So right now the market's winning, but in the long run, I believe that we are going to win on this. So I hope that answered your question. Now I am going to move on to Michelle's question. Are preferred shares still an option? What about exchange rates? Okay, that's two questions. The first one, preferred shares. Yes, preferred shares are still an option, okay, and I still like that idea. The way that I use the preferred shares, I'm looking for preferred shares that are paying me 4 or 5%, something in that zone, something that has a reset, and we're talking about Canadian preferred shares here. Something that has a reset. I would not, and I repeat, I would not buy any perpetual preferred shares. That's like buying a long-term bond. So those are off. They're not even consideration for me. I think if you do that, you're going to hang yourself. So don't go there. It's not a good idea. Preferred shares, you stick to preferred shares that have resets or minimum resets, or even better. Okay, I'm looking at preferred shares that are cheap, that are giving me 4 or 5% yield, or slightly more than that. Good quality. Okay, so I'm looking at P2 or somewhere in the investment grade, which is P2 or better. And you know, there's some great opportunities. I like getting paid while I wait. And for me, the preferred shares are basically a way to park money while I'm waiting for other opportunities to come up. And other opportunities are great companies that go on sale. So that's the idea. Now, so yes, preferred shares are still very much an option. And as I've said many times, if you want to get the updated preferred share list that Scotia produces, just send me an email and I'll be happy to send that off to you. And that's a very valuable thing. If you understand how to read it, it can be very useful. And if you receive this and you've got questions about how to read this or how to interpret it, I'm happy to take a call from you. Give me a call anytime. I'm very reachable, and I do answer my phone. I'm not like a banker. Okay, I answer phones. So call me and I'll be happy to walk you through this. I want everyone to get great value out of their experience with Purple Chips. That is what motivates me. Now, the second part of your question, Michelle, is about exchange rates. That is a wild card, I'll tell you, because let's look at, here, I'm going to pull over my Thompson 1 again, and let's look at the exchange rates. So I'm going to go in here, and that is the US-Canada exchange rate. Right now, we're at 126. This is a monthly chart of the exchange rate. And you can see that we had a little bit of correction. We had gone up to 148, imagine. That was back in January 2016. So that's when things were at their worst for the Canadian dollar. And right now, we're trading around 126. It's a tough call on what this is going to do, because I think in the background, the U.S. is losing its status as the go-to currency, and so that's why we've been declining lately. We've been coming off as people are less certain about, you know, what the U.S. is going to do relative to other currencies, and so the Canadian dollar has been strengthening on that. And I still think that we can trade. Whoops, sorry, I don't know what happened there. There. I still think that it's very possible that we could trade. I'm looking at a zone of 120 to 135, let's say, on the Canadian dollar. I think that's a reasonable expectation. And I think I would still expect a bias towards favoring the U.S., at least for now, although it's becoming a little more questionable. So that answers my the question about exchange rates. I hope that responded to your question, Michelle. And Yvon was asking me, Euronet and MTY are at low valuations. Would I consider sending out an alert? That's a good question, Yvon. And I'll tell you something. Euronet is an excellent company. It's definitely a buy. It's in the top 20 US, and I am buying it. Okay, I haven't sent out an alert, and I'll tell you what's going on is that in the background, we've been buying the top 20 and the top 6 Canadian stocks, and I want to do a webinar just on that. And so you probably think I've been a little bit quiet lately. Well, in fact, we've been rejigging our portfolios because we refined our strategy. And I'm going to elaborate a lot more on this in the next webinar about using the top 20 and the top 6. So to answer your question, Yvonne, yes, they are great companies. And am I putting out an alert? I'm not putting out an alert specifically yet, but I can tell you that I do think they are good deals, okay? And I think you can make money if you're patient with these. So I do like them. And Yvonne's also asking me, what do I think of Walgreens? And he's got, this is specific to Yvonne, he holds some January 2019 calls on Walgreens, which I also do. And what do we think of Walgreens? Well, Walgreens is a lot like Celgene in terms of, whoops, I just wrote something here, darn. Here, let me just fix this, wait a second here. Walgreens, I was in the wrong place. Here's the chart on Walgreens. This is something you gotta like, okay? This is, everything I see here tells me that this company, unless there is a big shift in earnings, which I don't think there will be, this company is terribly, terribly undervalued. Okay, historically, reasonably, this company should be trading at around 15 times earnings. And right now, the company is actually trading at 11 times earnings. Okay, so this is a bargain. These guys have shown over the years, and we're talking about the last 20 years, that they are a superior company. They have very low volatility in their earnings. And there's absolutely no reason to think that this can't be an $85 stock anytime. You know, this could happen. So let's look at the consensus numbers. The consensus numbers are still good. So we can see that the earnings are still expected to rise. Even the next quarter, they're supposed to earn 147, 148, according to the analysts. And it looks like the numbers will keep going up. So right now, 2018 expectations, 596, then 648. There's no reason to think that this company isn't a bargain. So I own it. I think it's a deal. I would definitely hold on to those calls. One thing, if you feel like you're, or actually, you know, one thing you can do, this is an advantage with options. I don't know if you own that company in a non-registered account, okay, in a trading account. If you own it in a trading account and you're losing money, this is a strategy that you can do that can help you. You take the loss, but with the option, you go and you sell the 2019 calls and you buy the 2020 calls. So you're taking a loss and you're buying the same thing just further ahead, and tax-wise, you're good. So you actually come out ahead. So this, you can make money by doing this. Now, if you need more explanation on that, I'll be happy to speak with you about that personally. Now, Rose is asking, Celgene is spending more on R&D than Qualcomm or IBM. Well, that's a good thing. If they're spending more on R&D and they are cheap, the chances are that they're going to come out ahead. R&D spending is always a long-term thing. And plus, that's a different industry. We're talking about comparing a biotech company with a Qualcomm or IBM, which is in technology. They don't spend nearly as much percentage-wise on R&D. So that's an interesting point, Rose, but in this case, it's a little bit different industry. And so you have to, when you look at R&D spending, you have to compare it to similar industries. And so we're going to move on from that. And let's see. Oh, that came from Raymond. Okay, actually, that wasn't even Rose's question. Okay, very good. So at this point, let's go back to the presentation. Okay, so here we are. Now I want to open it up. So we still have room for some questions. It is only, I think it's 12:20 right now. No, it's 12:30. So we've been on for half an hour, lots of talking by me, not too much from you guys. So I encourage you to keep the questions coming. Does anyone else have any questions for me? And we had scheduled our next webinar for May 22nd, but there's a possibility, if the interest is there, I might actually advance it by a few weeks. Because I'm excited about talking about this top 20 and top 6 thing, because I think there's an unbelievable opportunity here for everybody. And I was hoping that we could start initiating this during this correction, and we're doing it, but I'm not finished yet. And I'm actually putting this into practice in my own portfolio and with the portfolios of my clients. So this is something you're going to be hearing much more about in the next little while. So does anyone have any questions for me now? Well, I think I've done a lot of talking and everyone's pretty quiet. So I'm hoping that the message has gotten across on what to do in a corrective correction phase, let's say. So let's just go back. We're just going to review. The major points are, number one, cash is king. Okay, you want to avoid debt. Okay, avoid companies that have a lot of debt. Avoid companies that are exposed to interest rates. Okay, focus on companies that pay dividends because you want that cash coming in so that you can build up your cash reserve. Avoid companies that have very high PE multiples. If they don't have the growth rate to support a fantastic PE multiple, then be wary of that. Lower your expectations, okay? Nothing goes in a straight line, but expect that in a corrective market, you get something goes up, goes down, lower, goes up, the highs become lower, the lows become lower. You get the zigging and zagging, okay? Lower your expectations. Okay, if you thought a company is fantastic, company is worth X, maybe during a corrective phase, it's worth a little bit less, but eventually it will go up. But that might be a year away, it might be 2 years away, who knows? Trade some, hold some. So keep your cash levels high, focus on your really great companies, hold on to those. Don't sell them at a bargain price, okay? That's a big mistake people make. So the things that always focus on the quality, okay? You want to keep the highest quality items in your portfolio and peel off those ones that are making money, if they're making money, or even if they're breaking even sometimes. If you can upgrade your quality, it's worth doing. So trade some, hold some. And point number 7, sell call options, okay? If you are familiar with call options, if you're holding a stock and you can sell a call option, that creates, brings in cash for you and lowers your risk. It's something that's worth considering. So to resume, those are the rules to live by and how to survive a correction. And I hope that everyone's pulled a little bit out of this brief webinar. And I look forward to hearing from you or, getting your feedback on this. And don't hesitate to call me, by the way, okay? Reach out to me. I'm very responsive, and I like hearing the comments that people have and the questions. There's always ways that we can make you get more value out of your subscription. So I think that concludes it. I'm going to end the webinar now, and I want to thank everybody for attending. And it seems I've missed, let's see, answer the chat box. Rose has reminded me that Leon had one more question. Should one buy, I'm going to conclude right after this. Should one buy or sell calls or puts in non-registered versus registered accounts? First of all, Leon, you probably should know this as a portfolio manager or an ex-portfolio manager yourself, but in registered accounts, you can sell calls on stock, but you cannot sell puts, okay? You can buy options, but you can't go short options in a registered account. You can do whatever you want in a non-registered account. But when I'm talking about with selling call options, I'm saying sell call options basically on stock that you own. So you can do that in any type of account. But you can't just go and sell call options naked, as they call it. So anyhow, if you want more, if you want to discuss that further, you're welcome to give me a call. You know, I always enjoy talking to you. So let's see. I think. Oh, we got another question here from Leon. Okay, he holds BCE from a Manitoba tel exchange. Hold or sell BCE? Well, you can see on the screen point number 2: avoid debt. Now the telecoms already came down because of their their high infrastructure costs. Okay, and the fact that they always have a lot of debt. Personally, I think BCE is something that that I would prefer to own at a much lower level. So I'm not an expert on BCE, but I'm not buying it right now. Now I know it pays a good dividend, but they will be facing headwinds because of rising interest rates. So that's my take on it. And let's see what else we got here. And I think that's it. That rounds it up. So in conclusion, I'm John Schwinghammer, the author of Purple Chips, and thank you for listening in. And I look forward to your feedback and to talking to you soon. And so with this, I'm going to end the webinar. Thank you very much and have a great day.